This is the Independent Dealer Podcast. Education by dealers for dealers. Now, here are your hosts, Luke Godwin and Jeff Watson.
Hello and welcome to the Independent Dealer Podcast, brought to you by Buckeye Dealership Consulting. Luke, the end of the year is coming near, my friend, the end of the year. One thing that just really gives me a lot of anxiety at the end of the year is income tax burden.
Yeah.
You pay income tax?
Man, I tell you, I think I pay more in income taxes than I pay myself. Well, I don't think that, I know that. And so it's always a burden. And you know what, I look at it quarter to quarter because it's such a burden. So today we're actually going to talk about how can we get ahead of that. And we have two people here that really know their stuff, JP and Chad. Guys, welcome back to the show. I think it's your third time on. And let's talk about fractional CFOs and taxes and all that good stuff.
Thanks for having us back. It's awesome. I question your judgment having us back a third time, but it's a lot of episodes. We're happy to be back.
You were so bad the first two. They always say third time's a charm. So
there you go. Nice.
You know, it's funny because I look at this and it's the worst time of the year for us, at least for me, from a cash flow standpoint, right? Because I'm trying to stock up on inventory. You know, you're paying, end of year bonuses to people, and then you've got your income, tax burden that's coming due and a million other things. You're trying to, stuff as much as you can into your reinsurance company. So from a cash flow standpoint, it's just a really, really, really difficult time of year. But before we get into some of those strategies and what you guys would give us recommendations on, give us the pulse. I just want to know, you guys talk to a lot of retail and buy here, pay here dealers specifically. What's the vibe? Can any of you guys speak to, is everyone doom and gloom like me? Or are there actually retail and buy here, pay here dealers making money in 2024?
I'll start if that's all right. I think that you are in the majority, Jeff, and the minority is the other side. Folks like Luke that are pumping their fists and packing the wallet. But in all seriousness, I think that we went into 24 with some optimism, a little bit of optimism that, some of the things we saw in 23, that increased charge off from that fake stimmy money, as well as, sales volume, were going to kind of come back. And it's been slow. Everybody can get volume, right? But good volume, right, has been slow to come back. And so you couple that with, we were bracketing the pandemic, that 3-year kind of bracket, with 20% inflation, right? And so that all hit our bottom line, our people, our overhead, things of that nature. We've had trouble with cost containment. I think really in 2024 is when folks started to react to that and get a little more lean and scrappy. All the while, one more thing, triple, quadruple whammy is the cost of capital that we've really only got a little bit of break lately on. Starting in September, the feds gave us a little bit of relief. So maybe my summary is if, for instance, you made $2 million in 2022, that was chopped in more than half in 23. That same dealer may have made $500,000 or $600,000 in 23 and possibly a little bit of upside experience from that number in 24. That's been kind of my take.
I think the dealers who didn't pivot and waited till 24 to pivot from a cost perspective, or finally trying to hone in on what's working and what's not, I think may have missed the boat a little bit. And I think really, for going into 25, I think we're going to see a lot of the same that we've experienced here for 24 is what I'm going to guess. But I think dealers need to really take the time now to look at their expenses. What else can they cut? Take some of that modeling that they did for 23 or now for 24 and really, take a deep dive into it for 25 and make sure that they're taking into account, yes, interest rates are improving a little bit, but every other cost feels like it continues to go up, and that's not getting any better. And Jeff, you mentioned about bonuses, and every year we talk about bonuses. Is that bonus the same? Does it warrant the same as last year versus this year? I think our employees and people get used to that stuff, and we almost feel like we have to, even if the company didn't perform. But maybe there is a time where everyone has to share in the hurt. And I hate to say that, but I think it's easier said than done
Will
to
you sell it
sustain
to them?
employees and everything else. But sometimes, having a company survive versus giving out the bonus and then it crumble come May, that's just a hard decision, but one that might need to be made.
That's so true. And most people that listen know that I went away from a bonus structure for that very reason years ago. For one, people expect it, and you can't get out of expecting it. And tried giving them, when their bonus last year was, let's say, $2,000, try giving them 1,000 this year and see what happens.
Mm-hmm.
It will totally wreck you. Two other things that you brought up that are super important. Forecasting. Jeff, we talk about this every year around this time. You need to be forecasting next year. It's so important. It's so important to know where you're going to be, what you need to do, where you can expect to be at the end of the year. Second is expense cutting. I walked into 20 Group in December or January of this year. My expenses were so out of whack. And one of the reasons we've had a good year, I came back and immediately cut almost $200,000 in overhead, like within 30 days. And if you don't think that made a difference to the bottom line, it made a huge difference to the bottom line.
Aside from your auction houses and banks, take the top 20 vendors that you do business with and sit around with your management team and deep dive into, how much you're spending, why you're spending it. Is there another vendor that can do the same thing for us for, even if it's 5 or 10% cheaper, right? It may be worth the headache. But if you do that over the top 20 or 30 vendors that you do business with from during the year and go through that process, you're going to find savings and a way to cut costs.
Just not your fractional CFO. Don't cut that.
Darn Skippy.
You forgot.
So let me push back on that a little bit. So Luke, where did you find $200,000 in savings in 30 days?
The biggest cut initially was 2 staff members, maybe 3 staff members, two or three staff members that we had just gotten bloated. Okay. And I think that happened from 21. Well, let me rephrase it. It happened in 22 or maybe early 23 because employees were so hard to hire. Then all of a sudden you could hire them and you start hiring people, right? And so a majority of that was employees. That was the original cut, right?
Yeah.
3 employees. And then it was like 2 or 3 vendors that we just weren't using. And they were a couple grand a month. And so that's where it came from pretty quickly.
Yeah. I mean, I would say when I look at the biggest expenses for me that move the dial, and I think for all dealers, is obviously an employee. So are you right sized? That's really, really hard to judge sometimes because employees do a great job of filling the 8 hours and looking busy for the most part. And you worry like, okay, if I cut this guy and I redistribute those responsibilities, are they even going to get done? Or now are we just going to be neglected? Everyone's going to be running around like a chicken with their head cut off. They're going to be stressed out of their minds and they're going to quit. Right. So I struggle with that a lot. I think I've got way too many employees for the amount of cars I sell and the size of my portfolio. But I also like to think like, hey, if you need a day off, there's coverage. Hey, if you need to leave, we're not going to fall apart if one guy decides to call in sick because I'm at the size where I don't have multiple layers, right? I have one layer of employees. There is no redundancy in my organization. It's very hard for someone to step in and pick that up. If a collector's out sick, she is the collector. Like there is no backup collector. So I know I'm kind of stuck in that no man's land. The other spot would be I like vendors. I get it. If I cut $500 or $1,000 because I drop a vendor that maybe I don't think I utilize that much, I'm going to save some money. Now, if I tighten my belt a little bit in the Recon facility, like I'm going to pick up $500 every single day in my Recon, right? So I look at that and I think, wow, that's probably a place where and I don't want to say I'm dropping the standard of my reconditioning because I don't know that I can go much lower, but but that's an area where I really think efficiencies can be picked up. So what I'm saying with all of this, guys, is the old phrase of, don't step over dollars to pick up pennies.
Right.
We look at some of these and we're like, this is so great. I feel so great about cutting this guy out and that guy out. And you're like, well, now you just tied your employee's hands. And he actually did use that tool, and he was saving you $3,000 a month by having that $500 software subscription.
Well, and that's where it's important to get your management team sitting on the table to discuss those and not just make the decision yourself.
Yeah,
But
I agree with
Jeff,
that.
if you have figured out that everyone on your team is valuable, they add value,
Well, I never said that.
replaceable, and they're paid correctly, then something, and you're not profitable, then something else with the model isn't right. A deal structure, maybe the collection on the back end. I'm not saying you specifically, but if you've gone through all those exercises, you're still not satisfied with, getting an A- or an A on the test, then there's something else wrong with the structure of the business.
But
No,
we
I
do
definitely think so.
We do come across dealers, though, who ramped up during that 21, 22 timeframe
Yep.
with employees, and everyone's good, and we're just riding along, and nothing changed from 23 and now 24. And we've gone from 1,000 accounts back down to 600, and we're carrying the same staff. There's probably a time to evaluate, employees or the number of people you have in those kind of scenarios. And we quickly don't let people go as our portfolio deteriorates. Well, it's easier to add. We quickly add as we grow, but they usually don't fall off as fast.
Yeah, that's for sure. And I'm in the process of kind of looking at how to strategically dial things down, and that is an interesting thing. And I've poured over expenses like crazy in the last 2 weeks, and it's interesting.
Yeah. What I worry about sometimes is when I have employees who are maybe overburdened, and then they're just going to take the path of least resistance, right? So if my shop manager is overburdened, now he's just going to the same parts warehouse because he doesn't have the quote unquote time to shop around for the best price, right? If my collector is overworked, now she doesn't really have the time or the energy to really save that repo or work that deal, that account the way it was supposed to be worked, because she's just trying to get through her queue as quick as possible, right? Before the end of the day. So there's a lot of that stuff that I struggle with. Like, well, if I brought on one more employee as a customer service, intervention manager, it's going to cost me $3,000 a month. And the old adage is, well, what if they save you one repo a month? They pay for themselves, right? So we look at those expenses, but sometimes we don't tie them to maybe a non-cash expense like a balance sheet, right? Especially from a collector standpoint. I mean,
yeah, and I mean, this business can be like a cruise ship. You can't turn around like a speedboat, right? So you're going to see 12 months from now if it worked, right? If your attack of the portfolio worked. So, I mean, ideally you learn sooner, but
yeah, I'm finding that with changing over collectors. It's not overnight. And she gets frustrated. She's like, oh, why aren't my numbers better than the last one? I know I'm working harder. It's like, well, you're retraining our entire customer base to pay on time. Like, that's going to be painful because they've learned that they could give excuses. So yeah, you're turning around the Titanic right now. It's going to take a couple months.
And this probably isn't going to be a popular statement, but I think it's also a time that owners and dealers need to know all aspects of their business, and be willing to step in and fill the gap during, when you're downsizing and you maybe don't need a full-time additional collector, but you need a part-time. Maybe you're the part-time, unfortunately, for a short period or to get you through that. I know it's that might be scary for some, but
no habla español.
I was thinking, well, that's funny, Jeff. I was thinking back to when we first started really ramping up buy here, pay here portfolio, and I did collections every day. I sold 80% of the cars, right? I bought 80% of the cars. I helped Recon. And the further we get away from that, the harder it is to get back to it. I think that I'm gonna probably be doing some collections over the next couple of years, and some repoing and things like this. And I tell you, it is
is it exciting or is it depressing?
I can stand on my head. I can stand on my head for 2 years. So it's different. I think that one of those. I think Chad is exactly right, though. there is times when you're going to have to, if you're dropping accounts quickly, or you're dropping sales in the retail side, that if you don't shed expenses quick enough, you can be out of business sooner than later. And so you have to step in. You have to be willing. You have to know, as an owner, you need to know how to do everybody's job, every portion of everybody's job. And you ask me right this second, can I do everybody's job right now? Now, technicians, that's a different story.
Yeah.
I can do a lot of their job. I'm not going to do a lot of their job, but I could, but you can sub that work out. And if you say, Luke Godwin, could you do everybody's job? I can do everybody's job. There's no doubt in my mind I can still do it.
That's how you historically won in this business. It's not owners and big management teams sitting in, polished offices taking in huge salaries. It's, I'm gonna roll up my sleeves, figure out areas of the business, delegate it down, and wait to pay myself down the road. I'm reinvesting in this business, and maybe the same can be said in either a wind down or a pivot, right? I'm back in. I'm not taking afternoons off on the golf course. I'm back in, and I'm learning it, doing it, and wherever I'm needed, right?
Yeah.
Hey, everybody, real quick. I know we're talking about year-end accounting and changes and looking to cut those expenses. One way I have cut almost $30,000 out of a straight up expense is by switching my credit card processing company. So
Yeah.
it has made a big difference. When I look at my year-over-year credit card processing expense, it's literally down 30 grand this year. So it was huge for me. What about you?
Yeah, Blytzpay, just a great company. And, I'd went to the fee model before we switched to Blytzpay, but they could implement it super quickly. And I was saving 60,000 a month. I mean, 60,000 a year, something like that, I think is what we ended up saving. So it's the only way to go. People are used to paying fees. Get Blytzpay to help you do that, and actually get more money in the bank too. Their collection helping software is great. Give them a ring.
Yeah, and of course, I don't think that, I'm always kind of a stay on the offense type of guy, even during COVID when things got tough and it was like, oh, we need to cut expenses and cut advertising and batten down the hatches. I kind of look at it like, well, actually, while you guys all cut expenses and batten down the hatches, I'm going to put my foot on the pedal and I'm going to take market share from you in those times. So I do think there's a breed of dealer out there that is all gas and no brake. Right. They are all, hey, man, we're going full speed. I don't know what interest rates are doing. I don't know what Trump's going to do with this, that, or the other, but I am just pedal to the metal. Let's go no matter what. And I wish I had that mentality fully. I mean, some of those guys, you look at them and you're like, wow, good for you, man. Like you have no self-preservation button at all. Like you are going to the stars. And at the same time, when we see these economic tides turn, those are the kind of the cautionary tales of some of these big dealer groups or medium-sized dealer groups that just get obliterated by their large overhead. They have so many mid-level managers because they have 10 locations, 12 locations, and that non-producing overhead just eats you alive, I think.
The blowing and going like that, usually people throw bodies versus process towards the, towards filling in the gaps. And you end up, obviously bodies cost more than process most of the time. And so if you have a plan in place and you thought through it methodically to grow quickly like that or keep the pedal to the floor, then great, as long as you're making sure that you're staying on budget. But most of the time those guys don't have that plan in place to reference back to.
And that's the reason you have to forecast, and that's the reason you have to stay on top every month. And that's one of those things like, why, there's so many values to being in a 20 group. And one of the most important values, in my opinion, Jeff is probably not going to agree with this, is actually the owner entering in their composite numbers monthly. I think it's so important. And the reason it's so important because you get to see every freaking number and you get to see the comparison every month to that number. And so you can find out within 30 days, most of the time, if your numbers are totally messed up. And if you see it trending, then you can do something about it. But so many owners number one, aren't in 20 groups. And number two, don't look at their numbers like that.
Guys, tell me this. Let's transition.
Yeah.
What more should we be doing come the end of the year? We talked about looking at expenses and making sure we're right sizing. And that brings up another one. Look at all your vendor contracts and make sure you don't have any auto renewal clauses for next year that you need to be sending out notices for, because you may go try to cancel that vendor and find out you can't. So that's a whole nother episode. But what else should we be doing with this last 45 days that we have in the year to be sure that we're set up for the end of the year and to launch ourselves into 2025?
Yeah, I mean, tax planning, right, is top of mind for a lot of us. If we can get into that, I guess, for a minute. I think the title of this is At Least I Won't Owe Taxes. Well, I think it's level of taxes. Most folks are still performing well enough to owe some level of taxes. And so we're 45 days out. We still have time to, take certain action to defer tax. To do some more nuanced stuff like shift basis between companies to take advantage of losses. Car company generates a lot of loss, finance company makes money. Let's do the right thing to make sure we can take advantage of that. At a high level, one thing that I think about is we work with some dealers that still have their personal 1040 tax return locally, right? I'm loyal to this guy or gal. Their son's on my son's baseball team, but they've at least found the buy here, pay here tax expert. But those two don't talk. It's ineffective tax planning, right? If you do anything other than buy here, pay here, real estate, or anything else in the picture, then if those left hand's not speaking to the right hand, that can be a problem. So getting those two together, or moving the work to your buy here, pay here, tax folks.
That's funny you say that, because I did just interview a new local CPA to do my personal taxes and some of my my personal LLCs. And he had mentioned something about a SALT tax, that I can prepay my federal taxes, and maybe it was prepay my state taxes, and it becomes deductible on the federal level.
Yeah, been doing that.
Anyways,
for a while. Yeah.
that sounds like something. And I was like, well, that would mean that my dealership account would need to talk to my personal accountant, and like, you guys, you don't know each other, so
don't really want to
see that he's going to not know it's deductible, and I'm going to have a problem. So you're right. That's a really, really good point.
I mean, that and just there's a lot of little levers you can pull if you are facing a big tax. First of all, do you know if you're going to be a taxpayer, right? I mean, that's step one. Recent financials, connecting with your buy here, pay here tax consultant, tax CPA. And then there's a lot of little levers you can pull, that revolve around kind of some expense acceleration, CapEx expenditures, company cars, or, shop equipment, whatever it may be. There's still pretty favorable bonus depreciation that gets you a good deduction, before year end. And of course,
is it a common practice? Sorry, JP, are we still writing down our inventory at year end? Like writing it, if we have some aged units, are we still kind of marking those to market? Is that still a thing?
Yeah, I mean, depending on what your tax return looks like what basis you're filing under. Yes, that slow moving, obsolete stuff, or under market stuff.
That's almost a $200,000 a year deduction I take. So I mean, I would highly recommend people out there do that, depending on the size of their inventory.
Yeah, Luke likes to sit on cars for a long, long time until they depreciate.
No, let me tell you what I like to do. I like to save as much in taxes as I can. I spend the last 2 weeks in December just doing everything I can do to figure this out.
Do you rebook every single car in inventory, or you just pick your top 90 days and over?
I know I rebook every car. And depending on a lot of times I stack up cars for tax time. So I start buying them in, mid-October. And so by the time you get to December 31, those books have just taken a nosedive, and you know what they're going to do at the first of the year. So, and buy here, pay here cards, you're going to, the book is sometimes garbage on them anyway. So you can take a huge deduction. And I have an expense line in my DMS that I hit, and it all, comes to the P&L. I do it every year.
And this is getting a little technical and personal for me, but would you reassess that car with the included recon, or does that recon kind of stay out of that number? So say I over recon something and now I'm in at 10 grand.
So I write it down to the actual number, but that recon for some reason doesn't come in, right, JP? Or
I would take your total all in number and compare it to market.
That's I think that's what you do. Yeah, but
yeah,
there's some type of little fidget in there.
Yeah, I've got some cars that I had to put like 3 transmissions in them, right? So it's like, oh, I'm way over. I gotta bring my basis on this down because my salesmen don't even want to look at it.
Well, that's part of it too. A lot of retail dealers, and retail dealers, if I'm wrong, you can always send me a text to the couple of y'all that listen. And if you don't mark it down, and a lot of retail dealers will do it every month, because just what you're talking about, Jeff. If you don't write it down and get it to where where a salesperson wants to sell it, it won't get sold. So there's 2 ways to think about this. Is it saving you taxes? Yes. It also is right price in your inventory back to where you can sell it and make money. And it's super important. It's important on the buy here, pay here side as well, I think. A lot of people have argued against that to me, but we went through Friday. And I hadn't written the cars down yet, but we went through and probably marked down 15 buy here, pay here units that were too high. And guess what? We sold 4 of them within the next couple of days here. Because
that should be a throughout the year process, right?
Yeah, probably should be. They all just sit here until December, and then I write them down, and then they all get sold in January.
Yeah, exactly.
Do you, Luke? I was going to say, do you change the retail price in that situation too? Now that your basis is down, you also adjust the retail price. So you're just looking for an excuse to mark it down.
Well, that's what I was talking about last Friday. Me and my sales manager, we sat there and we said, okay, what's old? And we always look at the old units. We try to do it every 30 days, but we probably do it every 75 days probably is the problem. And we move the prices. And sometimes, we've gone up on stuff. We've gone down on stuff too. But typically, if you cut $1,000, $2,000 off your price, that seems to move the needle pretty quickly. We had one unit. This is just a quick anecdote. We had one unit that was priced well, and it wasn't moving. And it was a nice 2018 Ford Explorer Limited. I mean, the right one. And it just been sitting. Looked at the price, and I said, you know what? Let's just blow it out. Cut it $2,000. Somebody bought it Monday morning. We did it Friday at 5:00, and somebody was there Monday morning to buy the car. Because they've been watching it, and as soon as it dropped, they knew somebody was going to buy it.
And for me, you avoided that next curtailment fee, that this and that, and all that storage costs. So
storage
costs. Chad, what else should we be doing? Any other tips for us?
So I think a couple of the obvious that I know some folks would probably be disappointed if we didn't say, but setting up that RFC, if you're a new guy, there's still time probably to do that, to move some accounts over. If you're not profitable, it's really not worth the extra cost right now this year to set that RFC up. But if you're looking at a tax bill, then it's probably worth exploring. And then obviously there's still the reinsurance play and being able to move some monies over. Again, even if you're not set up yet, that's still an option to backdate sometimes some of those products and move a chunk over.
Is that the biggest thing a company can do to save on taxes? Is RFC? Not RFC, reinsurance.
So it's funny you mentioned that. I feel like with a handful of dealers that I work with that have been at this forever and reinsure everything, it's like a Trump tax return. Like, they're profitable, wildly profitable, but all the profits over on reinsurance. And that's great. It's a deferral and it's a slightly lower tax rate. So it's a win, right? By far the biggest. I mean, RFC is a huge factor as well, but by far the kind of the next in line.
So we're going to throw in a quick Buckeye ad, Jeff, since we're talking about reinsurance. Call the folks over at Buckeye. Get signed up. It's the biggest one out there. JP just said it, so we'll stand by it. Call Buckeye. They'll do it. Chad, a question came up the other day about an RFC. And you said something important. There's really no reason to do your RFC if you're not profitable yet. Where is the right number for most buy here, pay here stores, right number of accounts to set up that RFC?
I don't know if I necessarily have a specific number. I look at probably more the profitability side. But I think once you're starting to get to, I'm going to guess 200 to 300 accounts, it probably starts to make sense to look at that. For sure by 500. If you don't have an RFC, I think you're paying a lot more tax up front than you need to. And which usually ends up being at the end of year 2 to have that RFC in place. If you're selling 10 to 20 cars a month, by the end of year 1, you've probably got 150 or so in your portfolio. If you started January 1, and then so year 2, by the end of that, you're probably looking at wanting to make sure you've got some deferrals in place for that.
I wish I would have never set up a reinsurance, not a reinsurance, sorry, RFC.
Why?
I'm going to explain this. No, we waited for years to do it, right? We were in business for 20 years before we set up an RFC. It's a layer. Now, don't get me wrong. It saved us a bunch in taxes it saved my dad a bunch in taxes because I wasn't even an owner at that point. Saved him a bunch in taxes when I became the owner. We did it at the same time. But it creates more freaking hassle tax-wise for me than if I'd have just paid the $400,000 or $500,000 in taxes that it saved me right then. Because at some point you're going to have to pay it. It doesn't matter when you're going to pay it. So,
what's the cost?
Well, it's a whole other tax return. So
Yeah.
That's going to cost you probably 15 grand a year, let's say.
No, you're not paying 15 grand to run a separate RFC and tax return.
Maybe all
in, I'd be willing to bet you are.
in there's
No, you're doing quarterly reconciliations on your RFC through your accountant, and you're doing an annual tax return. It's maybe costing you, maybe 10 grand max.
10 grand. Let's call it 10 grand. But okay. I do all my reconciliations and all that. So that's done.
So you're like 5.
No, it's 10 grand. It's 10 grand, period. Okay. Then it's just the aggravation of having to sell all the accounts every year. I do it at the end of the year, so that's a pain in the butt.
It's all done automatically in your DMS.
No, it's not. I have to do it because I can't do a flat because my grosses are so low. I can't do a flat number, so I have to figure all this out.
Sounds like a personal problem.
It's such a pain in the butt. I just wish I'd have never done it. And then it's like, then you're reporting 2 companies, and then at the first year when we sell the accounts, all the customers go, "Why'd you close my account in Equifax?" And we got to figure that out.
Wait, you're reporting your dealership reports to credit for the first 12 months?
My dealership does, and then when it shuts down, then my finance company.
Oh, okay. Well, that's wild.
So there's like all these extra layers of crap that I have to deal with. I wish I would have never done it.
Not to mention you have double E Oscar. You have double everything. Well, that sounds like you just need to fix your processes. But so let me give the other side of it before people listen to Luke and think that that's the gospel or the way.
Now, one, you got to have the cash to pay your taxes, and if you don't, the RFC is the only way to go. So.
And again, guys, this is a timing difference, right? This isn't necessarily you're never going to pay the tax. This is deferring tax this year to maybe pay it over the next 3.
Yep.
Yes.
So guys that come to us, I received a call, and there was a guy, he didn't have an RFC. He had 600 accounts. He's been doing this for like 8 years. He's like, well, now all of a sudden I want to set up the RFC. And I was kind of like, he's not making huge profits right now. But setting up the RFC was just going to cause a headache.
Yeah.
To defer, he's already paid the tax. He's already paid the paper on that stuff. So it didn't make sense if he wasn't going to grow or be aggressive in that to set up the RFC now.
Mm-hmm. Yeah, that's what. And to me, so I started as an RFC. I didn't even have a dealership. I started with that first, just the finance company. But it only makes sense if you're growing, in my opinion, because once you hit that terminal velocity.
So that's where we were, Jeff. That's what I'm explaining.
You're paying as much. The RFC is paying as much as the dealership would be paying anyways. But here's the other caveat. I would say, and what I did wrong is I named my RFC too similar to my dealership. They're one and the same. You can't really tell the difference. The dealers that are really, really smart they name their RFC something completely different. It's a standalone entity. So if the day ever comes where they want to shut that entity down, or they want to shut the dealership down and just collect out the notes, the customers, it's more obvious that there's a difference, right? If my dealership closed tomorrow, my customers would still be paying the RFC, Jeff's financial institution at some other mailing PO box. Like, so if you're gonna set them up, make sure the front facing, the customer facing side is a completely separate finance company.
I don't ever think Jeff has good ideas, but it's a pretty good idea.
Thank you, buddy. Thank you.
The other great thing about the year end, Jeff, is tax max, right?
Yeah, man, it's tax time.
And tax max, they have the year end program that's going on right now, Jeff, and then the tax program at the first of the year. So if you haven't done tax max, make sure you hop on, give them a ring, or go visit their website, and they will get you more deals done for sure.
Yeah, what we're doing right now is we're reaching out to all of our low balance customers, and we're letting them know, hey, you can upgrade now. Upgrade your car. We're going to do an estimated tax refund. We're going to let you get a new car today, and then come back in January with your W-2s. That's when we'll officially file your taxes and do that, because these are customers that we have relationships with, right? They're going to upgrade their car somewhere. And honestly, a lot of them I would probably let upgrade with no down payment because they were great payers. But if I can get a promise for the future where they're willing to commit $2 or $3 grand out of their future tax return, and I'll do that as a balloon payment in April, dude, it's a win-win. They can get into something nicer, newer, which we all know is hard right now. A lot of times people come in and I'm like, hey, trade in. And they're like, well, you don't have anything on the lot that's better for the same payment that I'm paying now. And I'm like, well, yeah, welcome to inflation. So getting that tax money is a way to make those upgrades a little more doable for your customer.
For sure. Give Tax Max a call. And it's podcast 2024.
Yeah. I believe it's podcast
good.
2024. You get 40% off the VIP package, which is really the Cadillac package. They do it all. The customer files directly with them. You don't have to worry about it all. You just get a little notification that says, hey, somebody filed their taxes. Get them a car. So it's a pretty cool deal. Call the guys at TaxMax. It would be really hard because right now, if I decided to close my dealership, my finance company is called Four Seasons. So they're like, well, wait, the Four Seasons dealership shut down. That means my bank's gone. I'm out of here. I'm hitting the road. I got a free car. So
yeah, mine's Goblin Motors and Goblin Finance. I was really smart
original.
Yeah,
that's a problem. Okay, guys, sorry. What else? Give us one more closing nugget of wisdom that we need to be looking at in these last couple days.
Everybody's looking for capital right now, or maintaining it, searching for it. I think that, one thing that comes to mind is as you're getting the game plan together for next year, that's a projection, or that's, scrubbing your P&L and saying, here's how I'm going to improve. I think bringing your bank in the fold, letting them in cautiously on the game plan. Don't show them your bust, your home run swing, show them your single or double, is pretty prudent, right? Because maybe you're courting that local bank that at some point they trust you enough, they're going to give you a shot. But I kind of like being overly transparent when I can with the bank to just develop that relationship. They're your lifeblood for many dealers. Right? You don't have your financing, you're collecting out. So
I know Luke loves scrubbing his P&L, so that's I know he got excited when he said you could do that.
Oh, yeah.
Do you find that banks are being more generous? Well, since the election, the word I hear and just the the Twitter chat is that there are lenders that are ready to lend again. That both from a consumer standpoint, that they're kind of calling dealerships and saying, hey, so and so financial, we got money. Like, we're looking to get aggressive and get back on lending. Do you see that from the commercial side as well? Or any banks? Have you guys had any callbacks for dealers or banks saying, hey, like, what's going on? You got any deals for us?
I would say no.
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 All right.
I think dealer or banks that are in this space and know the space well right now have seen, some of this struggle, I think, through 2024, right? Delinquencies and different things that are still forefront. And I think banks are not necessarily gung-ho on lending unless you can truly prove yourself and you check all of those boxes that fit within their framework. And it used to be that you could get away with one or two of those not falling inside the box, but if you don't check all five boxes at this point, you're just not getting a loan, or they're not extending additional capital to you. They might maintain the existing relationship, but they're not giving you more, is what I've seen here more recently.
That's interesting. And, when we go to these conferences, every single dealer, when we were down in New Orleans last week, it was, how can I get capital, or how can I get cheaper capital? And I made this argument in a room, and I'm typically going against the rest of the people when I say something, but I said this for those companies out there that are charging 12 to 15% interest. There's Fortune 500 companies out there that are borrowing at 14, 12 to 15% interest daily. This happens every day. And I said, if you can expect that a bank is going to lend super risky business like ours money at a really cheap rate, some do, but I sure wouldn't. I wouldn't do it. I wouldn't lend Jeff money at probably 10%. And
I can't even give me a 20.
That's just me. I might lend it to him at 18%. But my point is this: if you can't make it work with higher money, then you've got to trim your expenses. You got to up your margins. There's not an interest problem. There's a margin problem, and there's a business running problem. And until people can understand that and understand they're going to have to pay market rate interest for the risky business you're doing, then you're going to continue to ask the same question. Pontificate on that, JP or Chad.
So, well, I think one of the things that we've run into is we got spoiled after 2008. We got spoiled as an industry when rates bottomed out
at 0%. Yeah.
At 0%. So all of the guys that were loaning out at 14, 16% are now loaning out at 11%, right? And then as rates have come back up, then so has, so everybody prior to 2008 that was in this business, I think, is just saying we're just back to normal, back in, this is just like before that. I don't think that was sustainable, being at zero long term as a country, but I think but everyone got used to that, and now we always reference that because majority of the guys who are in this business started somewhere between 2008 and now, right? There's a few old timers still around, but majority of the business, I think, has come in, and that's just what they've known, and they built an expense structure around 0% interest. And now they don't know what to do or how to approach that as rates have come back up, and that's why we see guys falling out like we are.
Yeah, we've got folks borrowing at those rates that you're referring to. Some are doing well, some aren't, but the ones that aren't, the rate isn't the problem.
Yes.
There are other problems in the business.
100% agree.
Well, we have a 20 group member, Luke, who's talked about it. I mean, he's talked to us about his interest rate, and it's like, dude, you are making the finance company rich. You were doing a lot of work, and you're making that bank rich.
But that dealer is taking steps to fix that problem, and he's doing well at it, right?
Well, he's taking steps to get away from the lender that is his only option.
That's right. But he's
into a different business model.
But he's cut costs as well in that time frame, and that lender helped him figure all this out. But it's too easy to get that money to start with and get your expense structure all messed up, and then when that happens, you got to dig your way out.
So one other tip to add that I just thought of would be, when you're doing that budget and that forecast, make sure you're referencing back to your bank covenants and everything else that you're having to adhere to. I see a lot of budgets put into place that are going to break all of their covenants. All right. So why are you shooting for something that isn't going to give you the best end result, right? When the bank's going to call your note, so you've got to have that plan. You got to know how all those pieces work together, and just make sure you're thinking through all of that. And again, that's where JP mentioned, bring your bank along, giving them, when we do forecasts, I feel like I'm more on the conservative side of doing stuff. But stress test that to say, what happens if my sales bottom out, or what happens if grosses go to all the different pieces, but you may not give the pie in the sky best budget to your bank, right? So make sure that whatever you're giving them is achievable. Don't give them that stretch budget that you're trying to give to your salesman or your manager to say, this is what your bonus is off of. Give them something that you know can be achieved, and that hopefully you're under promising and over delivering.
Oh, that's great. I mean, that's really good. That's really good knowledge right there.
Guys, hey, thank you for your time. Appreciate you keeping us on the straight and narrow here. How can people get a hold of you? Obviously your website, let's talk about that. And then maybe some of the like core services that if anyone listening wants to get into this stuff, what can you guys do for them?
Go ahead, JP.
Oh, yeah. We've got a website under construction, but it's mbac-accounting.com, MBAC. And, you know, our bread and butter, I mean, we kind of can run the gamut of accounting services. Of course, you know, we can provide outsourced bookkeeping, controlling services that focus around, you know, transaction journalizing and production of financial statements monthly basis. But really what is keeping us busy and hopefully valuable these days is you know, those banking relationships, courting and maintaining finance. It's, you know, budgeting and projecting. It's deep diving analytics, you know, and dealing with audits and reviews. That's our background. So really kind of finance and accounting, if it touches those areas in BHPH, LHPH, retail, then, you know, that's where we hope we can come into play.
That's what I tell people that are talking about, like, well, what's this, you know, what's this service? What's this? I said, when I go out and sit down in front of a banker, I don't talk banker, and banker doesn't talk buy here, pay here, right? They don't understand each other. So
Right.
what I call, you know, a you know, whatever, loss on note, or what I call this is, to them, that's like toxic. That's a toxic word. You just need to change the label of that account before you give it to your banker. So that's where the guys like Chad and JP come in and say, no, that's a reserve for bad debt. Like, that's a softer word. That's what we're going to call it. They like that word. So anyways, that's why you get guys like Chad and JP on your side, because they're going to help intermediate between you and the banks and make sure that you guys are speaking the same language. So guys, appreciate your time.
Thanks for having us.
Thanks, guys.
Real pleasure. Thank you all.
Thank you for listening. Please leave us a review. We'll catch you in the next episode.